Hello, this is Doug Gerlach from iClub Central. Today is Monday, April 13th, 2015, and you're here for our Lunchtime Stock Club webinar, where we'll take a look at a stock of interest, take a look at where the market is so far year to date, and also discuss other issues and any questions that you might have. So we hope you enjoy it, and welcome to our webinar. Before we get started, a reminder that if you're having any technical problems, you should contact GoToWebinar directly at 1-800-263-6317. You should maybe write that number down, mark it in a safe place, or remember that you can also go to gotowebinar.com. If you're ever having trouble logging into the webinar, or the application is not starting, or you're having any sort of technical problems, contact GoToWebinar instead of iClub Central support because they can facilitate repairing that or giving you workarounds. Reminder also, if you can't hear me, if the sound or graphics are choppy, don't run any unnecessary programs on your computer at the same time as the webinar. That'll free up lots of your computer processing power and bandwidth so that the graphics and sound can come through as swiftly and cleanly as possible. You can also always listen using the telephone, and we recommend that you don't use Wi-Fi for these webinars because we are broadcasting a lot of information that your computer needs to process. If you have any questions or comments, please use that question box in the GoToWebinar application. You can type them in at any time. I'm monitoring questions, and we'll address them as they come in, and we'll probably have some time at the end for open Q&A if there are any other issues you'd like to bring up. The archives and schedule of upcoming webinars are available at iClub.com. If you click on the Learning tab, you'll get that update as well as the links to the past webinars. And the archived webinars will frequently have a handout if one is available for that session, so you can download it for reference as well. You can review those archived webinars at your convenience on demand, all at iClub.com. Now, a word about some of our upcoming webinars. Next week will be our Investment Club webinar for treasurers as well as all Investment Club members on Tuesday, April 21st. Our Toolkit 6 webinar in May is on May 5th. And then please note there is a recent schedule change for our Lunchtime Stock Club in May. We had canceled it because I will be traveling on the second Monday of the month, so we're going to reschedule that to the first Monday of the month for May only, and that will be on Monday, May 4th, 2015. So you'll see alerts and updates for that off our regular schedule, but wanted to squeeze it in. We've had a lot of webinars this year so far where we've had to reschedule them, so hopefully that will work out for your schedule as well. That'll be updated on the iClub website shortly, so keep that in mind. Our May session of the Lunchtime Stock Club will be on Monday, May 4th. Finally, you can like us on Facebook. If you search for iClub Central, you can add us to your Facebook news feed, and that will give you updates occasionally when we release software updates to Toolkit or other programs, as well as release archives or make changes to our webinar schedule. So you'll find that all there on Facebook. Now, last week we updated Toolkit 6 to a new version 6.4.15. We talked about this in the Toolkit webinar last week, but I just wanted to touch on it again to address some of the lingering questions that many of our users have had. A reminder, you can always check your version by going to the Help menu and select About Toolkit 6, and there's also a Check for Updates button that you can, or link there that you can use at any time, and that will tell you if there are any available downloads that you can initiate following the prompts there and automatically installing those. By default, Toolkit does check for updates when you start the program. However, if your firewall is not configured to allow Toolkit to see the server, or if there are you've turned off the automatic checking of updates, you might not see that when you start up your computer, or if you're perhaps using your laptop and you haven't connected to Wi-Fi when you start up Toolkit, you might miss that update, so you can always manually check it then. This update had a couple of critical releases. You can always find those on the iClub website in the support section for Toolkit 6 that'll give you the detailed list of all of the changes and all of the updates. This is version 6.4.15 that we just released. That's the 15th minor update since we rolled out version 6.4, each one of them with about a dozen minor fixes and enhancements to the program. The key for this update was that the Yahoo changed their price file format, and that caused Toolkit to not be able to update prices if you were using the Yahoo Finance option. So that was, of course, out of our control, so we had to adjust the program to accommodate that change. The iClub Central price option remained available, so you could always get end-of-day prices using our price feed, which we provide for redundancy's sake because we've had experience with Yahoo Finance price file changes in the past, so we need to, we provided that additional functionality. So you can always, if you're having trouble updating Yahoo, make sure you're using the right you've got the right version installed of Toolkit, and then if you continue to have problems, check your firewall to make sure that Toolkit is allowed to speak to the servers to get to the internet to download that information. And as a last resort, you can always use that iClub Central price option. We had a problem with one ticker symbol. This comes up periodically. One ticker symbol will, for some reason, throw an error, so we fixed that for ISRG. There was also a sort problem in the stock library relating to the case of the first letter of the company name. It was missorting, so we fixed that. And then we also added a feature in the last update to allow you to more easily save multiple stock studies. This is to make it compatible with the functionality in SSG Plus and Core SSG that Better Investing provides, where you can save multiple copies easily. It didn't quite transfer over to Toolkit as well because of the portfolio functionality, and if you had your preferences set to always download a new copy of the stock study, you could end up saving multiple copies to your library. So we added an alert there just to remind you, if you have got a stock in your library already, don't save a new one or save over your existing file without warning. So that's the purpose of that update. On the overview and the alert screens as well as the reports, again, just enhancing some of the changes we made to our preference to use projected relative value and the preferred method of calculating that value using your user judgment of future PE ratios. So we just added some labels to clarify where we were using projected relative value and allow you to sort on that value in the reports. On the stock study, again, the relative value, projected relative value was sometimes displaying without a percentage, which was confusing to some people, so we've repaired that. And there was also some rounding in the calculation. In various places, we would calculate various values throughout Toolkit 6, and sometimes we end up truncating or rounding values to a certain number of decimal precision, and it ends up throwing off the results. They don't seem to match. So we just have to verify that the calculations are being done in the same way every time we produce a value. So we took care of that. And then there was a minor problem with the bitmaps. If you use that feature to save a screenshot of a graph, the quarterly trend graph wasn't including all the data that you had displayed. So those were the changes to Toolkit 6. Again, if you are having problems with price updating, make sure you've got the update installed. Make sure that your firewall or internet security program allows Toolkit to talk to the iClub and the Yahoo Finance servers. That's the only way that you're going to be able to get information into the program. And we've had some experience with Norton Internet Security where and Avast antivirus, various programs that want to lock out Toolkit or not allow you to update the program because they don't trust it. And again, we recommend that you add Toolkit to the exclusion list if those security programs, if they are interfering with the function of the program or the installation of the downloads. Our technical support can always provide help if you need it. So let's talk about where we are in the market so far this year. Here we are at the end of the first quarter. So we are into the second quarter of the year, and here is the graph that we like to look at that shows the performance of the S&P 500 in the light blue line, which is now at the bottom. The red line represents the return of the Russell 2000 small cap index, and that light green line on top is the EFA, the Morgan Stanley Europe Australasia Far East Index, so representing the markets in the developed world. And as you can see, following the uptick of the EFA index that we saw last month, it's extended its lead over the S&P 500 and the Russell 2000. Last month, the Russell 2000 was just a little bit ahead of the S&P 500, and it extended that lead. And so that's an interesting sign that the small cap market's kind of picking up nicely this year, while the S&P is lagging a little, only up 2% year to date. So that's a moderate performance, but if we continue that, if the market were to grow 2% for each of the quarters of the year, we'd be in the 8% year-to-date market return for the overall index, and I think that's that's in the ballpark of what many analysts were looking for this year, of S&P growth of about 8 to 12%, depending on who you were looking at, purely driven on an earnings basis, with the fundamentals still going strong, but the recovery is well underway in terms of the economy. And of course, lots of concerns internationally, but now the international market's kind of picking up. And what's the impact of the dollar on all of this? We're seeing a lot of international base companies that have international operations in the U.S. might be getting hurt a little by the strengthening dollar, weakening their results that are coming from overseas. So interesting. I like to look at these three market segments just as a reminder, because they do have a certain degree of non-correlation, and I believe that it's good to include companies that have international exposure, small cap and large cap domestic exposure in your portfolio. And that's why I like to look at these to see where the trends are and what we're looking at. If we refer back to the large cap market and look at the S&P 500 PE ratio, gosh, it's actually up. It's at the highest level if we ignore the outlier of that 2007, 2008 big blip there. You can see we're at a pretty heady territory. I actually drew a trend line there that shows you that the market has peaked in many periods just about at this level. Last month, let's see, we were at 19 point something. Hold on, let me grab that number here. 19.95 when we met in March, and so now the PE ratio of the S&P 500 is 20.55. So continuing to climb a little bit. Companies are starting to report this week. We're going to see a lot of the S&P and Dow large caps start reporting their first quarter results. So we'll see. The market at this point seems to be pretty optimistic that things are going on track, bidding up the market a little bit. Again, our tendency is to be conservative and not to expect the market to be delivering returns, not to expect these big companies to be delivering double-digit returns on a year-over-year basis. But it looks like a lot of the market has some pretty high expectations. That's what makes us a little bit nervous when the market tends to ignore the fundamentals and wants to continue driving the stock prices up of the overall market. But again, are we in bubble territory? Doesn't really look like it at this point, but it is a fairly rich valuation. So I think that serves to reinforce our consistent theme about where to go with the market, what to do with your investing, and that is to focus on well-run companies and buy them at reasonable prices. Don't get caught up in the market bubble. Don't get caught up in chasing chasing companies that don't have a good fundamental footing. Look for companies that have operational histories of positive growth and sound fundamentals. That's our bias. It remains our bias. And when the market is entering pricey territory, I think that's even more applicable for us to be focusing on good company selection. We're going to take a look at one of those companies that I think is a well-run business a little bit later in our webinar today. And certainly if you have any nominations for good companies at good prices right now that you're looking at, please share those, and we'll probably have a chance to take a look at them later in our session. Well, Warren Buffett is, of course, one of our gurus that we look to for advice about approaching stock analysis and approaching company analysis, what to look for. And so this month we're going to take a look at some of his words of wisdom on the topic of what he calls a margin of safety. And so Warren has said, when you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. And the same principle works in investing. So what does Warren mean by that? Well, he talks frequently about this concept of the margin of safety. And from his perspective, it means you only can buy a company when you can get it at a discount to its intrinsic value, or what we might call its rational value in our parlance. Even if the value of the investment is slightly higher than that rational value, it's usually better to avoid it, often better to avoid it. The difference in the price during bad times significantly can increase your losses if you overpay for companies. If you get caught up in the excitement and you buy in a rising market stocks that have higher PE ratios than average, that's going to exacerbate your losses when the eventual market downturn comes. Makes things a little trickier. So Warren suggests that you keep that margin of safety in mind, that you keep a certain what we also, in Toolkit and the SSG, we look at the downside, the upside-downside ratio. So what's the downside? And we want to have a good margin of at least 3 to 1 of upside to downside. If the margin of safety, the upside-downside ratio was 1 to 1, there's not enough there to mitigate the risk of a price decline that would come either from the normal gyrations of the market or a failure in the company to achieve the fundamental performance that we expect from it. So let's maintain a margin of safety in our portfolios by focusing on the prices and the valuations. Let's also take charge of challenging our companies on an ongoing basis and removing those companies that have low prospects for future total return. Even if they've been good to you in the past, they may be entering pricey territory as we look forward. So it pays to focus more on those companies that will deliver the best returns for you through good times and bad. So let's take a look at a stock of interest. This month we're going to take a look at a stock that we profiled in the last issue of our Small Cap Informer newsletter. Our Small Cap Informer newsletter has been, we're just about entering our 3rd year, so we're building up a track record. We're having a really good year so far in 2015. A number of our picks have performed quite well, and our performance numbers are picking up, so we're pleased at that. We've also, we attempt to diversify and look for stocks across a wide spectrum of industries. We've been punished for some of our energy picks, but we're increasingly finding, this year we found a couple of stocks in the financial sector, which in the small cap arena is a little bit tougher. In our last month, Lunchtime Stock Club, we looked at Columbia Banking, a regional bank in the Pacific Northwest that's been aggressively growing, not aggressively, but growing at a nice pace. A reasoned growth. They are making acquisitions and expanding their range of operations. We just thought they had, and it measures up to the larger banks in terms of a lot of the financial ratios that you'll look at. So this month we've got another financial stock, and this is United Insurance. So here you can see the history since it went public in 2008. Company's actually been around for much longer, but they went public in 2008, and you can see the results since that period. We took out the 2010 year and the 2008 to get a sense of the long-term trend. You can see sales have been upticking since 2011, as well as earnings and pre-tax profits growing nicely. United Insurance Holdings Companies, ticker UIHC, is a company that focuses on property and casualty insurance. So their primary business is underwriting these property and casualty policies for both residential and business owners. They offer the standard homeowners policies as well as for condominiums and multiple unit buildings, as well as flood policies. As a property and casualty insurance carrier, they're subject to regulation, of course, and they are licensed, which is interesting. They focus in, right now they've got agents in 9 states, which include Florida, Louisiana, Massachusetts, New Jersey, North Carolina, Rhode Island, South Carolina, and Texas. And if you think about the risk of hurricanes and tornadoes, particularly in the southeast, when you're talking about hurricanes and the North Carolina, South Carolina, Florida coastline, you're thinking about tornadoes in Texas. You've got a business that's focusing in high-risk areas, but this is kind of what makes United Insurance stand out, is their success in these areas where a lot of other carriers got hit hard in the last decade by hurricanes and other natural disasters, particularly in the southeast. And they've actually been performing well. They're one of the smallest property and casualty insurance companies in the U.S. You can see sales revenues in 2014 just at $280 million. But they have some financial ratios that really make them stand out. Their combined ratio is actually improved. It was 81.6% in the fourth quarter, and that's down from 82.7% in the last year. That combined ratio is the amount of premiums that it takes in compared to the payouts they make on policies. So if the combined ratio is greater than 100%, that means they're paying out more than they're taking in on premiums, and that's not a very sustainable business model. But theirs at 81% is exceptional. It means that they are writing policies that are profitable, and that they've also got a good reserve of cash. They invest conservatively, and their statutory surplus is about $126 million. So they've got a well-rounded financial base, and their geographic diversification also helps. You can see they had some states in New England as well. They have some Texas, Florida, and the East Coast. So that geographic diversification, and as they continue to expand their business, also helps them, because it means that it's not as likely that you're going to have natural disasters affecting Massachusetts at the same time as they're affecting Texas or Florida or the Carolinas. But what's great is they've actually got licenses to operate in an additional 9 states. So they've got 9 states where they're selling policies now. They've got licenses to operate in 9 more, and they have a plan to be rolling out sales of policies with agents in those additional states. So that's their growth opportunity. They've carved out a niche looking at a high-risk type of insurance coverage, and they're doing a good job at covering their costs and making money. Good management structure there. So we see the possibility of a 15% growth of sales and earnings. You can see with our outliers here, sales since 2009 have grown at 27% and earnings at 37%. So we think 15% is pretty conservative. Since the publication of this recommendation, the price is about $22. Now it's about $20.50. So it's come down a little bit in price, and the upside-downside ratio, which was, when we recommended it, 3.2 to 1, is now closer to 4.1 to 1. There's a tiny dividend about the yield. The present yield right now is about 1%. So there is a little bit of a yield component to the total return. The question here is the pricing of property and casualty insurance. There's a concern that the pricing overall is already at the maximum level, so companies are not going to be able to grow by increasing that property casualty insurance premiums, so they have to add additional business. We think United Insurance is probably a little bit protected from that because they are rolling out policies in additional areas, and their margins are already substantial and pretty high. So we think they can absorb the risk and maintain a good growth rate. Yes, there are no earnings estimates available for United Insurance based on the pro forma data. Sales is easier to see what analysts are looking for, but the earnings was a little harder to interpret. So we're sticking with the 15%. I think analysts on the street are actually looking at a little bit higher growth rate estimates. If you look, let's see. The analysts that we looked at, the consensus was growth in excess of 20%. So we're being a little conservative and ratcheting things down. If you want to see the earnings in the fourth quarter, we're up 62%. So we think that they've got a good chance at making that 15% average number and actually exceeding it over the next 5 years there. Dick says UHC is up to $21, so it's up about 50 cents on the day already. So that gives you some opportunity to still get it at a reasonable price, and watch, use your limits if you want, limit orders if you want to make sure to get a good price. It is small, so it does have some volatility built into it there. So United Insurance, a company that I think is worth a look. I'll share that with you. Our complete analysis, of course, in the March issue of the Small Cap Informer newsletter. At the current price, probably looking at return of between 18 and 19% based on today's price and the valuation. Just another note, the PE ratios for United Insurance, typical for many stocks, are in the last 52 weeks, the PE ratios range from 6.2 to 13.7. Again, that's very typical for financial stocks to see those lower PE ratios. If you were looking at a company that was growing earnings of 62% in any other industry practically, the PE ratio would be much higher. So don't be thrown by that if you're not familiar with how financial stocks, insurance stocks, bank stocks are valued by the market at those lower PE ratios. So you'll see that when you take a look at your stock symbol. So ticker symbol UIHC, United Insurance Holdings. All right, let me just mention a couple of upcoming events, and then I'll take a look at some questions that we've got going there in the question box. Next weekend, I'll be the weekend after next, rather. I'll be in Philadelphia. They're having an investor education day. They've got some good speakers lined up, and I'll be making a couple of presentations. That's in the Philadelphia suburbs of Willow Grove. If you're in the New Jersey, Delaware, Pennsylvania region, you can feel free to check out the Better Investing website for information on that Investor Day. Then in the beginning of May, I'll be in Northeast Ohio. I'm doing a workshop for the Northeast Ohio Better Investing chapter outside of Cleveland, doing a review of the stock selection guide and my tips for how to analyze stocks. I'll be at the Money Show in Las Vegas, again, making presentations. I've got a panel discussion with Mark Hulbert and some of the other editors of his top-rated newsletters where we're looking at stocks for a bear market. And then I hop over to the Better Investing National Conference in San Jose. So I hope many of you will be there and be able to meet and talk with you. And I have a full slate of classes on Sunday at the National Conference. Then I'll be back on the East Coast in June at the InvestEd Conference in Richmond. And then I've got a the Chicagoland Better Investing chapter is having a conference in September, and I'll be out there presenting at that conference, as well as our usual webinars and well as our retail investor conferences online that are sponsored by PR Newswire and Better Investing. We've got a full schedule of events coming up. Joy says, do I have plans to be in the Dallas, Texas area? I'd love to go back to Dallas. Haven't been there in a couple of years, but I don't have any plans right now. You can maybe talk to the chapter there and ask them if they would like to invite me. I'm always available to arrange workshops for the various Better Investing chapters where I come in and we'll do a half day or a full day, 4 or 5 sessions where we tackle portfolio management using Toolkit, stock studies, screening. We can really put together a program for the chapter to help with their education. So feel free to recommend that to your local chapters if you'd like to see me in your area in person. So Dennis has a question. What's my guidance for in making buying decisions for thinly traded stocks or dollar values? Say we only bought stocks that trade at least 100,000 or 200,000 shares per day. How would that compare to high-price stocks that might trade 50 million per day versus the share quantities? That's a tough question to address pretty concisely. We do, in our small cap informer, focus on stocks that have some more that are more thinly traded, don't have as much float, not as many shares outstanding, so the price tends to fluctuate a little bit more, and more importantly, the spreads tend to fluctuate, tend to be a little wider than for stocks that trade a little more actively. Really, the only thing that you can do is remember your discipline. You can use limit orders to make sure that you're getting the best executions possible. I would suggest using an all or none order. When you place orders for those thinly traded stocks, that will tell your broker not to do a partial fill where you might only get a certain number of shares of your order, particularly if you're making a somewhat larger order. So that designation, all or none, AON, will tell the broker if they can't fill your whole order of a couple hundred shares, then don't fill it at all at that price. Sometimes with more thinly traded stocks, if you don't have that designation on your order, you might end up with multiple fills at multiple prices and or not getting getting charged extra on the commissions. So I would kind of recommend staying away from that. The limit orders, again, for the most part, I'm not as concerned with the execution price as long as it sort of is reasonable when you place your order, reasonably close to what your stock study tells you in Toolkit is sort of the maximum. Generally, you're okay, but to be on the safe side, it's always good to be a little more prudent and to set a limit price so that you'll get your executions at that price or lower and not see those prices get too far ahead of the level at which you're comfortable purchasing that stock. You can use the same principle for larger companies, but again, I think it's particularly if your broker charges you more, it's just not as prudent a use of your investing funds to pay extra for limit orders on larger company stocks, but certainly in the small cap stocks. And I don't have any rules of thumb as to what level of liquidity to look for. You just got to kind of take it on a case-by-case basis when you're looking at these small company stocks, but you can often see. And, you might be surprised. Some of these small company stocks are not trading a lot, as Dennis points out. They're not trading very frequently. And so all of a sudden, your order of a couple hundred shares makes up half of the morning's volume. That doesn't always give you a warm fuzzy that you're the biggest purchaser of stocks in a particular time period. So you gotta. But on the other hand, if you're disciplined, you will come out ahead. This is just a general risk of investing in the small cap market, is that sometimes you might be right but the rest of the market doesn't know that, so your investment kind of sits there and is subject to all sorts of forces that aren't driven by fundamentals, and confuses the situation. It makes you feel like you did something wrong. It's a hazard of small cap stock investing that sometimes you're going to have to hang in there and wait for the market to recognize the fundamental strength, wait for the company to reach a size that allows other institutional investors to pay attention to it and start investing in it. And that can take some time. So you just have to watch out for it. You asked, based on my knowledge, what do I expect the mid-cap and small-cap markets to do versus the large caps this year in 2015. When we looked at the market at the beginning of the year, sort of similar to last year, was looking at analysts looking for 10 to 12% overall returns from the large cap markets based on the improving economy and the fundamental growth. But last year was not very strong for the small caps, but that was coming off of a stronger market in 2013 for small caps, where small caps really surged ahead. So I think that we expect that the small cap and the large cap markets to move out of sync. A lot of that has to do with the economic cycle and where we are in the economy. Different points, small caps and large caps might surge ahead. There's some thinking right now on the street that the strengthening dollar is impacting, I mentioned earlier, the results of large cap stocks that have significant international exposure. You look at the average company on the S&P 500, more than 50% of its profits come from outside the U.S. So those domestic large cap stocks, as we think of the S&P 500 companies, are actually international large cap stocks because of the base of their operations. The problem with that is, with the strengthening dollar, it weakens the results that they're getting from overseas, and that's going to impact their performance. Small companies typically don't have that sort of international operational exposure. Some of them certainly might have some, but not to the extent of the typical company on the S&P 500. So I think the market is thinking, well, until the international economy situation kind of resolves itself, that small caps actually have the potential to outperform fundamentally large caps because they're not risking this exposure. We're at a point in the economic cycle where the small caps are really finally getting the lift that the small caps had been feeling, or that the large caps had been feeling at the end of 2014. As it's trickled down, and now the small caps can kind of build their business back up. So I would not be. I'm not going to predict that the small caps and the mid caps will outperform the large caps this year, but I think there's a good chance that that's going to happen. I think there's a lot of concern. Of course, if there's a market correction, it's going to impact small caps, large caps, and mid caps pretty evenly. But I think the fundamentals are strong right now as we look at the small caps. As they got ahead on the valuation side in 2013, they retrenched a little in 2014, but the fundamentals kind of brought the valuations back up to a reasonable level. Where price was. So I think now, the small caps retrenched and are moving forward. That, again, doesn't really help us. We're looking for a 5-year perspective when we're looking at stocks. So, I expect that within the next 5 years, we're going to have a market correction of 10 to 20%. I expect that the economy is going to perhaps go into a recession in the next 5 years. Why? Because historically, that's what happens. On average, every 5 years, the economy retrenches. On average, we see market corrections happening every 60 months or so, and then it comes back. So that's the prediction over the long term, but we just don't know it's going to happen this year. And we know that the current expansion in the market is pretty long, well above historical averages, the current bull market. It doesn't mean that we have to have a bear market soon, but it does increase the likelihood that at some point there's going to be some sort of triggering event that's going to push the markets downward. But we'll just remain to see and focus on good company analysis. George, back to you. UIHC, what's the competitive landscape for the company? Well, this is what we liked about the company. In terms of the competition, you're seeing a lot of the larger insurers took big hits during some of the natural disasters in the 2000s, and they were looking to push through price increases in the regulated markets, or they were looking to withdraw from particular regions, particular markets. Some states had to make some threats to some of these companies, say, no, you can't pull out of property and casualty, because you're offering homeowners, you're offering auto and liability, other policies in the state. You have to offer all types of policies. We're not going to let you get out of the riskiest types of insurance just to protect your bottom line. You got to serve customers if you want to license in our state. So you do see a lot of the bigger players pulling out, but UIHC has really shown that it's a niche player that really does well in its markets. It's rolling out on a controlled basis. So that's what we liked about the company. I think the competitive landscape is pretty good for the business. As I said, they're optimistic that the rollout into the 9 additional states that they're doing gradually now is really going to help them expand their operations base. It'll increase their geographic diversification as well as their overall risk diversification. So we think that's going to impact earnings positively. You can see that big uptick in pre-tax profits in 2013 and 2014. We obviously don't see that continuing in that level, but even if it stabilizes at the current level of margins, which have been increasing nicely, since 2011, the pre-tax profit margin has gone from 13.5% to 23%, and the 5-year average is 16.3. So even if it stabilizes at a level somewhat lower than 23, it would still be a pretty solid number. So I think we're pretty optimistic about it. Question about Caesarstone, which is a company that we highlighted earlier this year in the Small Cap Informer, and in the Investor Advisor Series actually picked it up in the latest issue as well. The ticker is CSTE, Caesarstone. This is a company that makes kitchen counters. That's their focus, and they are globally based, so they've got business operations around the world. So Eric says, in researching the company, came across a website that had pretty negative reviews on the company's product. How would you factor something like that into your stock study? Well, so we're talking not about the company's fundamentals. We're talking about their product from one website. I'll tell you, I think of product webs. I use product reviews when I make purchases. I look at Amazon.com. For products that I'm buying, technology, books, music, etc. I also, when we're traveling, we rely on reviews from the TripAdvisor.com website pretty substantially. My partner Jennifer is a top reviewer there. She's got hundreds of reviews every time we travel internationally. She makes notes, and we review the places we stay, and we rely on the site to help us make decisions about where to stay and what to see. But the thing that you realize is there's always going to be a certain portion of the reviews that are that you can discard right off the bat. They're either very negative or very positive. Sometimes people will give a negative review on TripAdvisor because the museum was closed on the day that they tried to go to it. Well, if the museum was closed, you can't really fairly give it a review. So we're able to, discount those negative reviews and look at the aggregate. And that's what we need to do, look at the aggregate. One website that may review the product negatively doesn't account for the growth that the company is seeing in product sales. So the company would not be growing product sales on a consistent basis year after year if its product was of a low quality or an undesirable level. So one review, again, I would discount and keep it in mind, but I wouldn't let it necessarily affect my analysis. Now, if you found dozens and dozens and dozens of reviews that all mention the same sorts of factors, that could give you a clue. But again, people who have complaints are often more vocal than those who have compliments. So again, we kind of take it in stride. I think all of our analysts on the IAS and the small cap side who've looked at the company have concluded that it does have some good opportunities for growth going forward. So that would be my my final analysis when we really look at it. Okay, let's. We've got another couple of minutes here. So a couple of people have asked about a couple of different stocks, and none of them I'm familiar with. So I'll fire up my toolkit, and we'll take a look. The first company is SBH. Joy says, how do you feel about the SBH? We bought it thinking short-term years ago for $5 to $6. Now it's around $33. Do you think it's a keeper, or is it getting time to let it go? This is Sally Beauty Holdings, so they operate, I believe they operate stores with beauty supplies. And the graph, I think, gives us one little warning sign, and that is that sales are moving along, but that's a 6% growth rate, $3.7 billion. So it's 6% is below our sort of minimum expectation for a large cap stock, and this is really a mid-sized company. And obviously the downturn in earnings last year is something to be concerned about. You can see the I guess it's a slight uptick in earnings, but when you look at the quarterly earnings for the first quarter rather, ended December 31st, you can see that they were even with last year, and sales were up 2.6%. So you know, I don't know what analyst estimates might be, but analysts looking at maybe 15% growth. Let's if we assume 6% sales growth and maybe 12% earnings growth, again, just on a thumbnail, you know, it just seems like that seems pretty high to me, you know, visually based on what their potential is. So ratchet that down to just under 10. So, and then just quickly, kind of just to give us a sense, we've got high PE ratio of around 20, low maybe around 12. Again, just to kind of rough thumbnail here. From $33, the high price, so if you assume that the stock would trade at a PE of 20, which it has barely done in the last 5 years, I think 20 is pretty excessive, and earnings growing at 10% gets you to $48 from $33. So that's not a very good rate of return on the company. So based on that, I would seriously think about challenging it. I would want to know, you know, the margins are, you know, they're stable at that 10% level. That's a pretty stable trend, whether it says up, down, or otherwise. So we kind of have an assumption that maybe the margins can stay at that 10% level. You can probably back into a pretty reasonable earnings growth level based on 6%. Sales growth, but you know, it's hard to see what the upside is from here. This is a niche product, you know, beauty supplies, so not something that I think necessarily is going to scale out significantly. So my consensus would be, let's challenge this company and see if we can find some better return candidates. Certainly doesn't seem to have the growth profile that I like to see when we're looking at companies. But maybe you know more about it than I do, so that, again, that's just back of the envelope sort of calculations there. American Tower, AMT. So this is a company that, look at this sector, is actually real estate. REIT diversification. Growth is pretty good. I mean, this is some pretty 16% sales growth. If we take out some of these earlier years, just to kind of get a sense of what earnings has been in the last since 2008. Yeah, so 17% sales growth, pretty consistent. Earnings growth, a little less consistent, but still, moving in an upward direction. They seem to be on an every other year cycle there, and I'm always a little suspicious of that. But again, this is a REIT, so we're just looking at earnings, not funds from operations. We have to back into some of the numbers and get a better sense of it. Certainly, the sales revenues have been growing at a decent enough rate given the size of the company. But again, you want to back into funds from operations here to get a sense of where things really stand. The yield based on price, about looks like it was 1.8%, the high yield last year, so a little bit of a dividend. But again, we don't want to look at the EPS as we do funds from operations, and the only way to do that is to do a manual analysis. So otherwise, I don't have any comments on the company or opinion on it. Dick says, what about BRK, Berkshire Hathaway, to balance a portfolio with a large cap company? I'm often optimistic, generally optimistic about Berkshire Hathaway and the A or the B shares, but it's primarily, I think of it as a large cap mutual fund. I don't know how you think of it, Dick, but I tend to think of it as a large cap mutual fund. So I think it makes a good portion of your portfolio that you want to allocate towards larger companies and just include it that way. We can look at it on the stock study on the SSG, but it really doesn't fit the model as well as. Well, let's go ahead and we'll fire it up, and I'll show you what I mean. So we'll look at Berkshire B. No, we'll look at Berkshire A. Yeah, it looks better than I thought. Sales actually kind of increasing about 9% over the last 10 years. You can see earnings taking a hit during the last financial crisis, but generally growing at 7%. So it's within our threshold of a large cap stock, in this case, I would ratchet down our sales expectation about 7%, earnings around 7%, something like that. Give you a sense of the valuation. It's hard because you can't really value the business as you would a growth company, because that's not the focus. The focus isn't growth. It's on Warren's concepts of intrinsic value, but I was in an investment club that did own Berkshire B, and it did well for us. And I think it's a kind of a core holding that you might consider in lieu of a large cap mutual fund as part of your holdings. But you can see the numbers get all kind of wacky because of the size of the business, and the valuation ranges, pretty tight. But again, because it's just an enormous company. But again, I'm not arguing with Warren, and I think it's a good idea to take a look at it. Dwayne asks if I refreshed your view of LKQ recently on private webinars. No, I haven't talked or really looked at LKQ. It's tracked by the Investor Advisory Service, and so they do update on it. I know it's had a little bit of pressure recently, but the IS is still pretty optimistic on it. It still rates a B, and again, as the price and future returns kind of come down, total return expectation about 21%. Growth rate still looking at 18% growth as of the February issue. So I think again, if you take the long-term view, I don't think that at this point there's nothing that isn't unexpected or is that really going to change up our view of it at this point. But again, that's just based on some of the recent talks. Nancy wants to know my opinion of oil. I don't have an opinion on oil right now. It's it's a tough period. We're in a tough time where the energy structure of the country is kind of changing. Domestic production really ramped up when gas was getting above $4 a gallon. There was a real incentive for a lot more drilling and exploration a couple of years ago. So what happened is we started producing a lot more oil and gas than we needed. Then there was a recession that drives down demand for oil and gas, so coming out of the recession, the growth just wasn't there, but companies were still producing. So we're in this great position where we're producing more of the oil and gas that we need domestically, which decreases our reliance on international imports. Excuse me. But demand is also not grown as we see a lot of alternative energy sources taking hold. That's going to impact demand as well. So I think that all bets are off as to what's going to happen. We've kind of reached this tipping point where supply and demand and the mix of energy sources is changing significantly, and that I think that could well have a significant impact on what's to come compared to previous trends. I mean, energy is typically cyclical. It goes up, it goes down. Demand for oil and gas goes up, down. Production goes up, down. And they never quite come together. So I think a lot of energy companies now, oil production companies, are pretty speculative. But as they bottom out, again, where's there to go but up for those particular companies? But I have no particular insight into where or when. We tend not to look at those oil companies. This is Evercore Partners that Diane asks about. I don't know anything about it, but companies in capital markets tend to not reflect well on the stock selection guide. I really want to know more about what it does. If they are a investing business or an operating company or a business development company, or what their entity is, tends to not be able to get a good grasp of the analysis here if it's sort of more of like a closed-end fund type of investment. But the SSG wouldn't throw me off. Certainly, some sort of startup angst here, but the last couple of years seem to be heading in a consistent direction on a comparable level with the sales, the growth of revenues. So I wouldn't decline taking a look at it, and I might take a further look at this company on my own and kind of give you a sense of it maybe next time. Oh, I'm sorry, Nancy's talking about Oceaneering International. Again, I have no knowledge. I'm not familiar with that particular company. Oceaneering International, again, tend to stay away from those types of companies. Although we do follow, and I'm pretty optimistic about our handy-size liquefied natural gas carrier, and the name of the company has gone completely out of my head. But that's the only kind of shipping company that we take a look at. Joy says, HAR is a stock I've watched and wanted to buy when they split. Are there indications to determine when a split will occur? No, and I put really no stock in buying before or after stock splits. There's not really, it's just like making change for $1. So I don't care. And wouldn't advise looking at companies and making buy decisions based on when splits occur. There's a tiny uptick that tends to happen after stocks split. I think that might be from people who are a little more inexperienced and get excited about stock splits. Others of us know that it's really nothing much to get excited about. There's evidence that companies that split their stocks have greater price appreciation than companies that don't. But it's not a cause and effect relationship. It makes perfect sense that those companies would see greater returns than companies that don't split their stocks, because companies that split their stocks do so because the share price has gone up, because they're doing things fundamentally well. So that's why the returns are higher. It's not because they're splitting the price. They're splitting the price because they have earned returns, and shareholders have a bias for stocks that are not so expensive on a per-share basis. So they do it to accommodate shareholder interest. But that's my take on stock splits. Not really interested in looking at companies that split or buying before or after splits. All right. Well, we are right at 12:30. I'm sorry, right at 2:30 Eastern Time. So let's go ahead and wrap up this session. Donna says losing sound off and on. I don't think there's any problem from what I can see. The transmission has been pretty strong, so it's probably what you've got going on your own computer that might be impacting the delivery of sound. But I want to thank you all for coming. I hope you enjoyed this session, and thanks for the stock ideas. And please feel free to email me, girluck@iclub.com, if you have any other questions. And we'll look forward at seeing you next month at our next Lunchtime Stock Club. Thanks again.